Depositors. There are 3 regional banks in the US right now that look normal on the surface, but behind the scenes they're showing almost every forensic sign of being under quiet regulatory control. Your app still works, your card still swipes, branches are still open, but if you hold serious money above FDIC limits at the wrong place, you could be the last one to find out that your bank has effectively been taken over before the press release ever hits. I'm OG John AG, and in this video I'm going to walk you through how secret receivership really works, the 6 hard red flags that sophisticated investors watch, the 3 specific banks flashing those signals right now, and a practical action plan so your savings or business cash doesn't become collateral damage in the next regional bank wave. By the end, you'll know how to audit your own bank like an insider, and what to do before that famous Friday night FDIC announcement hits your screen. Segment 1. What secret receivership actually means. Let's kill the Hollywood version first. Most people imagine FDIC receivership as big announcement, doors closed, logo gone overnight. In reality, there's a whole spectrum regulators use long before that moment. Think of it as a resolution continuum. On one end, open bank assistance. FDIC and the Fed quietly provide liquidity, but the bank stays under its own management. On the other end, full closed bank receivership, seized on a Friday, shareholders wiped, assets sold or liquidated. The dangerous middle stage is where a lot of 2026 risk lives. Bridge bank, conservatorship, operational receivership. Here, regulators effectively take operational control. They replace or constrain senior management. They restrict dividends, share buybacks, and growth. They tell the bank how to shrink, merge, or sell, but the brand and branches stay open. The legal tools are consent orders and memorandums of understanding, confidential agreements where the bank accepts strict conditions to stay open. To the public, it looks like business as usual. On the inside, it's quiet receivership. Segment 2. The history. S&L crisis and 2008 showed the playbook. This isn't new. There are 2 big case studies. Savings and loan crisis, 1980s, 1990s. Over 1,000 savings and loans failed between 1986 and 1995. Taxpayers ate more than $160 billion cleaning it up. Regulators didn't close everything at once. They used forbearance, letting effectively insolvent institutions keep operating to avoid blowing up the insurance fund. Many zombie banks kept reporting positive capital ratios that were fiction while being quietly supervised. Savvy depositors and investors who understood this pulled uninsured deposits, rotated into treasuries and money market funds. Avoided massive losses when those zombies were finally resolved. 2008 global financial crisis. FDIC officially seized 25 banks in 2008, 140 in 2009, 157 in 2010. But that headline number hides dozens of banks under consent orders and prompt corrective action directives. No new branches, no dividends, forced capital raises, weekly or daily reporting to regulators. This was operational receivership without the announcement, so the system didn't panic. Sophisticated players watched. Dividend cuts, executive departures, Fed and Federal Home Loan Bank borrowing, subordinated debt and preferred stock collapsing. When Washington Mutual finally failed in September 2008, the insiders were gone months earlier. Retail depositors and shareholders were the last ones in the building. Segment 3. Why 2026 is dangerous. Commercial real estate's maturity wall. Fast forward to early 2026. On the surface, banking isn't even the main headline. You hear more about inflation, Fed policy, and stock valuations. But underneath, a slow-motion bomb is ticking in commercial real estate, CRE. Key facts. Over $1.5 trillion in CRE loans are maturing in 2026-2027. Many were written when interest rates were around 3%. Offices and retail spaces were 80-90% occupied. Now, occupancy in many downtowns is closer to 50%. Refinancing happens at 6 to 7% interest or more. The math doesn't work. Revenue is down. Debt costs are up. Building values are 20-40% lower than the loan assumptions. Owners are walking away. The hit lands directly on the banks that funded these loans. Crucially, the top 25 U.S. banks hold less than about 30% of total CRE exposure. Roughly 70% sits in regional and community banks, often concentrated in just a few cities or property types. So, losses are concentrated, not evenly spread. A New York or San Francisco-centric regional with 40% of its book in local offices and rent-controlled apartments isn't challenged. It's in a knife fight for survival. FDIC's own problem bank list is rising. 52 institutions with $66.3 billion in assets as of Q4 2025, up from 43 a year before. That list ignores the many banks under confidential enhanced supervision. The real stressed universe is much bigger. Segment 4. The 6 red flag signals of quiet distress. If you want to know whether your bank might be in this quiet danger zone, you don't need inside information. You need to watch 6 public signals. Dividend suspension or sharp cut with no strategic reason. Healthy banks like to pay and raise dividends. If a bank suddenly slashes or suspends its dividend without announcing a major acquisition or investment, it usually means regulators want capital preserved. Executive turnover in critical seats, CFO, Chief Risk Officer, Chief Credit Officer, rapid resignations, personal reasons, or no clear successors point to serious internal or regulatory stress. Heavy reliance on Federal Home Loan Bank, FHLB, or Fed discount window short-term borrowing from these backstops is normal. But when advances exceed about 10% of total assets for a while, it screams, we can't fund ourselves normally. SVB and others in 2023 were drawing heavily here right before they collapsed. Subordinated debt and preferred stock trading at big discounts. If a bank's subordinated bonds are at 30-40 cents on the dollar, the bond market is pricing in losses or forced recapitalization. These markets are dominated by institutions with serious analytics and sometimes better info than headlines. Delayed or amended financial filings, late quarterly call reports, restatements. Footnotes about valuation changes or loan loss reserve fights. These are signs the bank is negotiating with regulators and auditors about how bad things really are. Concentrated CRE exposure versus capital. More than 300% of equity capital tied up in commercial real estate, especially in one metro or property type. A 20% loss on that concentrated book can wipe out capital and force prompt corrective action. One signal alone is a yellow flag. 3 or more together, especially in a CRE-heavy regional, that's where quiet receivership becomes very plausible. Segment 5. The 3 banks in the crosshairs. Now the part everybody wants, names. 1. New York Community Bancorp, NYCB. Profile, around $116 billion in assets. Huge exposure to New York multifamily and other commercial real estate. Warning signs. January 2024, 70% dividend cut, surprise $260 million quarterly loss, big jump in CRE loan loss provisions. Stock crashed over 60% in weeks. March 2024, raised over $1 billion in emergency capital. Terms highly dilutive, a desperation move, not victory lap. Multiple CFO changes and amended financial statements. Over $44 billion in CRE loans, more than 300% of equity capital. Heavily rent-stabilized properties in NYC, a sector hammered by regulation, higher costs, and falling values. Bond and stock markets are extremely volatile. Subordinated debt trading at stress levels. NYCB itself disclosed being under a supervisory agreement requiring stronger risk management, internal controls, and governance. Code that it's under enhanced oversight. 2. Valley National Bank, VLY. Profile, around $61 billion in assets. Major operations in New Jersey, New York, and Florida. Warning signs. Heavy CRE concentration, especially multifamily and offices in the New York metro. Rising non-performing loans and CRE provisions. Dividend not cut yet, but share buyback suspended and management publicly focused on capital preservation. Stock down more than 40% from highs. Subordinated debt priced for elevated credit risk. Exposure to the same rent-stabilized multifamily segment crushing NYCB, where regulation plus rates have turned many buildings cash flow negative. Earnings calls are defensive when discussing CRE exposure, another tell that the official story is rosier than internal stress. 3. Flagstar within NYCB. Flagstar was acquired by NYCB in 2022. It brought its own large CRE book and stress into the combined entity. Before the merger, it had suspended dividends, reported rising charge-offs, and faced capital pressure. The merger was marketed as scale and synergy, but practically became a distressed combination, 2 weak portfolios stapled together. Flagstar still operates as a brand, but as part of NYCB, it lives under the same supervisory regime and concentrated risk. Taken together, NYCB plus Flagstar form one of the largest CRE risk concentrations in the regional system. Segment 6, what this means for your deposits. Now the part that affects you directly. FDIC insurance basics. Coverage, up to $250,000 per depositor, per insured bank, per ownership category. If you have less than that in a simple individual account, your principal is protected, even if the bank fails. But 2 key realities. Protected, instantly accessible. In a receivership, FDIC aims to give insured deposits access within 1 to 2 business days, but it's not guaranteed. If you run payroll or rely on that account for operations, a 2-day freeze can be a disaster. Above $250K, you're an unsecured creditor. Uninsured deposits stand behind secured creditors and ahead of equity. Recovery depends on asset values after liquidation or sale. In deep insolvencies, uninsured depositors can lose 30 to 70% of their funds. The legal framework for bail-ins, converting part of large, uninsured deposits to equity, exists under Dodd-Frank's Orderly Liquidation Authority. It's not just a European story. A Cyprus-style hit is legally possible here if things get bad enough. If you keep large balances in a stressed regional, you are effectively lending to that bank for free unless they're paying you a premium. Segment 7. How to audit and protect yourself. Here's your action plan in plain language. Audit all your bank relationships. List every institution where you hold cash, sum your total per bank and per ownership category. Mark every place where you're above $250K. Bring exposure below the limit where possible. Spread deposits across multiple banks to stay under $250K at each. Use different ownership categories, individual, joint, business, trust, where appropriate and legitimate. Use safer cash vehicles for large balances, treasury-only money market funds. Direct short-term T-bills and government securities. These are not FDIC insured, but they carry U.S. government credit risk, which is vastly safer than a stressed regional. Yields often match or beat savings accounts. Set up backup banking for businesses. Open secondary accounts at more than one institution. Put wire protocols in place now so you can move funds quickly if you see trouble. Keep an operating buffer in treasuries or money market funds you can tap if a primary bank freezes. Monitor your bank like an analyst. Watch for dividend cuts, CFO or risk officer exits, big jumps in FHLB discount window borrowing, and bond prices on the bank's subordinated debt. If you see multiple red flags, don't wait for a press release. Quietly move uninsured funds. If you must hold uninsured deposits, demand compensation. You are taking credit risk. If your bank pays a near zero rate while loading CRE risk, you're being exploited, not rewarded. Fair compensation for large uninsured deposits at a stressed institution should be hundreds of basis points above risk-free. Segment 8, the bigger credit cycle and your next move. Step back. Why is all this hitting now? We are in the late stage of a credit cycle that started in 2009. Years of near zero rates and QE encouraged maximum loan growth, not maximum prudence. CRE looked safe. Big assets, steady rents, can't miss collateral. Then rates jumped 500 basis points from 2022 onward, and values fell 20 to 40% in many markets. Loans written at 3% and high loan-to-value are now underwater. On a mark-to-market basis, many CRE-heavy regionals are insolvent. Accounting rules and forbearance let them pretend otherwise until maturities force reality. FDIC's insurance fund is finite, about $129 billion at the end of 2025. It cannot eat the simultaneous failure of hundreds of regionals, so regulators are doing what they did before, managing failure in waves, pushing distressed banks into quiet supervision, forcing shrinkage and mergers, avoiding headline panic while depositors who don't understand the game sit in risky institutions. Your edge is simple. Don't be the last, uninformed, unsecured creditor. Move your cash to where the credit risk is lowest and the yield is still fair. You've been watching John AG here, and I'm OG John AG. If this helped you see the difference between my app still works and my bank is quietly being managed toward resolution, hit like so this kind of early warning breakdown doesn't get buried. Subscribe and turn on all notifications because the CRE maturity wall and quiet FDIC supervision aren't a one-week story, and the people who protect their cash will be the ones who understood the pattern before Friday night.